Howdy, folks. Welcome to Liberty Call. Today is Wednesday, May 3rd, 2023. Hope everybody's having a fantastical day out there in the interwebs. My boy Jake's sitting here under my desk. He's wanting to go play ball in a minute. Here, he's making an entrance. You just saw him walk past me. He really wants to go outside. It's a beautiful day here in Colorado. It is 65 degrees, according to my computer. Sun, no clouds anywhere in the sky. Maybe some chemtrails if you're into that sort of thing. But other than that, and the Astros are on. They're losing 3-0 in the bottom of the eighth. I don't know. Let me ask you folks out there. I know this is not financial related. Do you like these faster games, in baseball? I personally don't. I mean, the game's been on for less than 2 hours. We're already in the bottom of the eighth, and they're losing 3-0 to the horrible Giants. So, and for, an old NL West guy like myself who grew up watching the Astros in the 80s, I hate the Giants. I hate the Braves. I don't hate the Padres. They were never a big problem. But, the Dodgers. Can't stand them. But anyways. All right. As you can see, Jake's taking his resting spot back there. So let's get through this in 10 or 15 minutes. The big news of the day was that the Federal Reserve has raised interest rates. I'm sorry. Maldonado just got a single. We got two people on base, no outs. But the Federal Reserve raised rates by 0.25%. Woo! Into the world. I'll show you what happened with the charts in a minute. But the markets did not react very well to that. So I guess they were hoping that the Fed would say, we're going to pause. We might even print some money for you folks out there. Didn't happen. I know I've been saying that for over and over again. But all right, let's go ahead and jump into the numbers and see how they finished up for the day. The Dow Jones was down 0.8%, 270 points, closed at 33,414. The S&P 500 was down 0.7%, closed at 4090. NASDAQ was down 0.46%, closed at 12,025. The VIX was up 4.33% today. It's at 1855 right now. Canada was down 0.26%, Brazil was down 0.14%, and Mexico is down 0.38%. Over in Europe, Germany up 0.56%, UK up 0.2%. Let's see here, France up 0.28%, Netherlands down 0.01%, so flat. Spain was flat, down 0.06%, Italy up 0.77%, Switzerland up 0.73%, and Portugal down 0.92%. Russian exchanges both in the red today. We just hit into a double play, so we got a man on third, two outs. Let's see here. In Russia, the MOEX was down 1.86%, the RTSI down 1.1%, and the overnights in Asia, the Nikkei in Japan was up 0.12%. Oh, no, that's they weren't open today. Let's see. Australia down 0.96%, New Zealand down 1.13%. All these Chinese markets are still closed from the way it appears. The Hang Seng down 1.18%, and the Taiwan weighted down 0.53%. All right. I apologize for being all stuffy. I woke up this side, couldn't breathe through it. I mean, it was like concrete in there. I took some, generic Sudafed or whatever was in the cabinet. I can sort of breathe, but when I'm doing a lot of talking, it seems to clog it all up again. So if I sit here silent and, my nose clears back out again. So, but it is pollen season here in the mountains. Ooh, Breggy just hit a 2-run home run. We're down by 1. Woohoo! Way to go, Bregs. All right. So let's go ahead and dive into today. Well, actually, let me show you the chart. Where'd it go? Where's my charts at? There we are. So let me show you the chart and let you guess, when did the Fed make their announcement? See, everything was pretty smooth, nothing too volatile, just kind of moving around near the flat line. This is the Dow Jones. And then right at 2 o'clock Eastern time, Jerome Powell started talking, and you just see the volatility just going crazy. And same thing with the S&P 500, kind of smooth, not a whole lot of jumping around, just, kind of trying to figure out what's going to happen today. And then 2 o'clock, looks like someone having a heart attack on their EKG. So, like I said, I think people were hoping that the Fed was going to come back and say, we've decided we're going to just print a bunch of cash, drop it out of helicopters, and everything will be fine. Didn't work out that way. All right. Market recap, Fed lifts rates by 0.25%, signals June pause amid shift to data-dependent stance. All right. The Federal Reserve raised rates by 0.25% on Wednesday, bringing its benchmark rate range to 5 to 5.25%, the highest level in 16 years. Oh my God. The rate hike not only lifted the Fed's benchmark rate to the peak level predicted in March, but also marks the fastest pace of rate hikes seen in 4 decades. Yeah, since the early 80s. The Fed has waged a campaign against elevated inflation, and while inflation has shown signs of cooling, many worry about the threat posed by a strong labor market. The Fed has stated that its monetary policy measures will take time to slow the economy and bring down inflation. At the same time, the Fed has been warning about pressures in parts of the economy, including regional banking, commercial real estate, which are emerging as potential risks. Following the collapse of several regional banks, such as First Republic, many on Wall Street are looking out for further pressures in the sector that could trigger a sharp decline in lending activity and weigh on economic growth and inflation. Goldman Sachs has warned that tighter credit conditions are likely to slow growth in 23 by about 0.4%, equivalent to the usual impact of 40 basis points of rate hikes. In addition to its rate hike, the Fed also signaled a possible pause in June, though it stressed that that incoming data would guide future monetary policy decisions. The shift to a data-dependent stance marks a, quote, meaningful change, end quote, according to Fed Chairman Jerome Powell, who said that future policy decisions will be driven by the incoming data meeting by meeting. In its May policy statement, the Fed noted that policy decisions, quote, will take into account the cumulative tightening of monetary policy, end quote, and incoming data, marking a shift from its prior language in March that said the Fed anticipated, quote, some additional policy firming may be appropriate, end quote. All right. Let me blow my nose here for a second. All right, I'm back. Whew. All righty. Next up on the docket, U.S. services sector still growing. Inflation remains sticky. So some good news here. The U.S. services sector maintained a steady pace of growth in April, according to the ISM, as new orders increased amid a surge in exports. However, businesses continue to face higher prices for inputs, indicating that inflation could remain elevated, despite darkening clouds gathering over the economy as lagged effects of higher interest rates start to have an impact. Services businesses in the ISM survey were fairly upbeat. 14 services industries reported growth, including accommodation and food services, utilities, public administration, transportation, and warehousing. 3 industries reporting a contraction were mining, agriculture, forestry, fishing and hunting, and wholesale trade. Finance and insurance companies were described business conditions as, quote, steady, adding that they were, quote, preparing for planned expansion in the third quarter, end quote. Businesses in the professional, scientific, and technical services industry reported that they were, quote, well on track to still see significant growth in production through calendar year 23 as well as 24 and 25, end quote. Retailers described business trends as stable year to date, and that's in quotes, nothing that inventory levels are coming more in line to match the new lower demand trends. The service sector is being supported by consumers shifting spending from goods, which are typically bought on credit. The ISM reported on Monday that its measure of national manufacturing contracted for the 6th straight month in April, though at a slower pace. A gauge of new orders received by services businesses increased to 56.1% from 52.2 in March, and a measure of exports orders jumped to 60.9 from 43.7 in March. However, tighter credit conditions coupled with banks tightening lending could make credit inaccessible to households and small businesses. A standoff to raise the federal government's $31.4 trillion borrowing cap also poses a grave risk to the economy. Yeah, I personally like to see it fall apart. In addition to the higher borrowing costs, the Federal Reserve raised its benchmark overnight rate by 25 basis points on Wednesday and signaled it might pause the U.S. Central Bank's fastest monetary policy tightening campaign since the early 80s. With demand solid, services inflation persisted. A measure of prices paid of services services businesses for inputs nudged up to 59.6 from 59.5 in March. Some economists view the ISM services prices paid gauge as a good predictor of personal consumption expenditures inflation. The Fed, which has a 2% inflation target, tracks PCE price indexes for monetary policy. Services sector employment growth slowed further, more evidence that the labor market was softening. The government's closely watched employment report on Friday is likely to show non-farm payrolls increased by 180,000 jobs in April after rising 236,000 in March, according to a Reuters survey of economists. The unemployment rate is seen climbing to 3.6% from 3.5% in March. All right, so not all terrible news. Now on to the bad news. One last article here. The banking collapse of 23 is now officially bigger than the banking collapse of 2008. So awesome. All right. According to observablehq.com, the three banks that have collapsed in 23 collectively had more assets than all 25 banks that collapsed in 2008. While 2008 saw the peak in terms of asset size for bank failures with $373.6 billion and only 25 failures, 2010 saw a peak in the number of banks failing with 157 versus 25 in 2008. So far in 2023, three banks have failed with a combined assets of $548.5 billion. Even including the $170 billion in assets from failed banks in 2009, 2023 is still worse than the two great financial crisis years combined. Unfortunately, the banking collapse of 23 is far from over, and many more banks are currently teetering on the brink of disaster. According to executives at those banks, investors should not worry. First Republic was the latest bank to issue similar assurances just last week. However, that was a lie, and now First Republic is toast. The FDIC took over the bank and entered into a purchase and assumption agreement with JP Chase Bank to assume all of the deposits and substantially all of the assets of First Republic Bank. Shareholders of First Republic got completely wiped out. Good for them. Yeah, make a bad investment, that's what you get. Although we shouldn't be bailing out the depositors, because if you had more than the FDIC limit, too bad. In comments made after the deal was consummated, JP Chase CEO Jamie Dimon boldly declared that, quote, this part of the crisis is over, end quote. Anytime someone says it's officially over, they're probably full of crap. As Charlie Munger recently observed, and Charlie Munger is Buffett's sidekick as far as investment decisions over at Berkshire Hathaway, observed, many of our banks are absolutely packed with bad loans right now. The 99-year-old investor told the Financial Times that U.S. banks are packed with bad loans that will be vulnerable as of May 3rd, 2023. We are only 1/3 of the way through the year, and with many banks currently teetering on the brink of disaster, there may be more to come. All right, so that's everything from a news perspective for today. The Giants just hit another home run. We're losing 4-2, top of the ninth, one out. I don't think the Stros are going to come back today, so then they blew yesterday's game too, which was quite upsetting. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.